Your topic that we have today is from FRM Level 2, and it's from paper 1, that is market risk. And topic is one of the most important topic, that is backtesting value at risk. And yes, please do subscribe to our channel. It takes a lot of efforts to come up with videos like this. So let's have a look. And yes, I mean, you will notice that we will try to stimulate your thought process to enhance your learning. And stay till the end of the video. There would be a lot of aspects from the level 1 that are also covered in the video. So this was one of the query that was asked in one of the group. So like, I think there is some typo here. So say, for example, there is a 99% VAR model that has a true level of coverage is 97%. So there are, I mean, actually it's a 99%, but true coverage of that model is 97%. That is, loss exceeds VAR 3% of the, say, for example, if there are 250 days, 3% of the time of 250 days, your loss will exceed VAR instead of 1%. So eventually, what this statement is saying, your actual VAR model is 97% VAR. Further, assume that either yellow or red zone outcome signifies rejection of the model. So we will look at this, what is yellow and red zone, and we'll be uh, walking through the entire presentation. If the committee were to decrease the green zone from 4 exceptions to 3, so currently actually you will notice there is a table from the Basel which says 4 exceptions are allowed. But now what Basel is trying to say that uh, now they will allow only 3 exceptions. So, or fewer, 3 or less. So green would be less than or equal to 3. Currently it's less than or equal to 4. What is the probability of type 2 error? Would chance from 12% to what? So currently if there are 4 exceptions, the chance of type 2 error is 12.8%. We will see that where these numbers are coming from. So in a single question, lot of understanding would be tested on type 2 error. What is type 2 error? Hypothesis testing, and your understanding on value at risk, backtesting VAR. Lot of, I mean, stuff would be covered in a single question. So these are the options. Of course, we will see what's the final results of this. And there is a second type. So there are basically on backtesting, these are the major categories of question that can be asked. So in this, actual use of hypothesis testing, so practical application of hypothesis testing, you can say. So suppose daily loss exceeds above predetermined BAR level at 95% confidence level on 22 days during 250 days period. Is the sample unbiased? So you are asked to calculate if it means that if the sample is accurate, if unbiased means accurate model, ideally option should have been yes or no, but we can still conclude model is faulty or model is not faulty. Question is, we need to conclude if model is faulty or not. So out of 22 days, out of 250 days, there are 22 days on which the VAR is actually exceeded the calculated amount by the model. So we need to conclude if the value at risk model is accurate or it is faulty. So before you solve these kinds of questions, you need to have a very good fundamental understanding of few topics, I would say. So these are the topics we would cover. What is backtesting value at risk? And why. So what and why would be covered here. Why, what is a backtesting? Why do banks do backtesting? And over here we would cover how part of it. How do we backtest? And to understand backtesting thoroughly, you need these topics from level 1, that is hypothesis testing, type 1 and type 2 error, binomial distribution, value at risk. So you may notice that how important level 1 topics are. for your level 1 foundation. And trust me, level 2 market risk backtesting VAR is one of the most important topic. And of course, if you are planning to explore in the market risk domain, then this is one of the key topics for the interviews. And followed by exercise. Exercise, we will solve these two questions. And if you got any questions, you can put in the comment box of the channel. So what is a backtesting VAR? So backtesting valueatrisk refers to the process of assessing accuracy and reliability of valueatrisk. So you are trying to assess whatever model you have to calculate valueatrisk. Is it accurate and reliable? By comparing its predicted risk measure with the actual outcome. So see how you actually validate the accuracy. You try to compare what you had predicted and what is the actual outcome. So that's the backtesting value at risk. And why do banks do backtesting? So these are the two main reasons. But if you were to understand in a very layman language, so you can just think of any manufacturing company. There is a quality check for products that are manufactured. In a similar way, in the financial world, if financial institutions are using any models, so it is very important those models are validated timely basis so that they are accurate and reliable as far as their usage is concerned. And it validating or backtesting BR, it refrains banks from willfully understating the risk. So what happens that if you don't if banks don't backtest value at risk, then there is a room for banks to understate their risk. Very risky from the systematic risk point of view. So most important one. And there are Basel guidelines. So you need to monitor exceptions to value at risk. So the region that we were talking about, green region. So it's four. If you have four exceptions, uh, then you don't have to keep any additional capital. And if there are more than five, six, more than 4, 5, 6, so likewise your capital will increase accordingly. And 10 or greater, it falls under a red zone. So there is a high need of verifying the model that is calculating the value at risk. So in our question, we were asked that if this is Bessel is or plan to have it from 4 to 3, what is the probability of having type 2 error? That's what we have to ask. That's what we were asked. So let's see. So as we saw that these are the prerequisites from your level 1. So you need to know hypothesis testing, type 1, type 2 error. So basically, if I were to touch upon this, you say that, say you are confident that you are 90% confident that you will clear FRM. Okay, so this is a hypothesis. You need to test with some statistical tools. So that is a hypothesis testing. In deep, we will see the second question that we had to apply this hypothesis testing concept, but in a very layman term, it's just a testing of your assumption. So when you come out of exam, you just based on your experience, you say that it's 90%, you're 90% confident that you will clear the exam. That's the assumption. So that has to be tested based on certain statistical tools, observations, and type 1, type 2 errors. So if I were to relate in this, type 1 error is very straightforward. So if I say that I'm 90% confident, that means there is a 10% scope of error that may occur. So that is called as a type 1 error. Okay. So that means you expected some positive outcome, but that ended up from some negative outcome that was left out. So 90% you were positive, but actual outcome came from the negative side. So that is called as a type 1 error. And likewise, type 2 error is other way around. So there is some negative outcome that was expected, or you just think of a simple layman example. So just letting some guilty go free from the court verdict, that would be a type 2 error. We have that in next slide. So you because you don't want any innocent to get punished, so you did not have that much evidences, and you let it go some culprit free. So that is a type 2 error. And binomial distribution, as name suggests, that there could be two outcomes. So say, for example, so I'm explaining over here binomial distribution, or let me go explain it in the next slide in a white because it's colorful. So writing may not be that greatly visible to you. And value at risk. Value at risk, of course, I'll write just a definition in the next slide. So this was something I was talking about. Type 1 error is something actually, as I said, the outcome actually came from the negative one, but model outcome was not guilty. So you predicted that you will pass exam, but actual outcome came from the fail. Just God forbid you fail, but that's the type 1 error. You were 90% confident, but actual outcome came from the 10%. So if I were to draw the pictorially, so this is a 10% error is area wherein the error scope is there. So you predicted that outcome would be from here. It was your prediction. You were 90% confident, confidence level, but actual outcome came from this. So this was predicted and actual came from the error area. So that we can say that error scope of that error is 10%. So 10% of the times you may end up getting as against your prediction. So that's the type 1 error. As against type 2 error, in type 2 error, what happens that your model says that area the outcome would be from this area, but actual comes from this area, not guilty. So it's other way around over here. So type 2 error, your actual prediction is from here. Right, let me write a prediction only. So your prediction was from this area, but that point actually the actual outcome came from this reason. So that is called as a type 2 error. So you predicted that someone will be faulty thing, but that was actually not faulty thing. So in context of VAR, you can say that you predicted that VAR model would be faulty, but actually it was accurate. So in your question, you are expected to calculate this probability if for exceptions less than 3. So exceptions to VAR less than equal to 3. You have to calculate this area for exceptions less than equal to 3. So let's see how we do it. So another prerequisite that we need is, so we covered hypothesis testing over here, 90% confidence. And so that's the assumption that you are trying to test. Type 1, type 2 errors. Now we are trying to calculate binomial, but before that, let's see VAR. Because if you were to test value at risk, so you need to, if you were to backtest your VAR model, first you need to understand what is value at risk. It's a maximum loss at given confidence level in a given time frame, in a given time. So it's a maximum loss. You say that you are 95% confident that your loss would be X. So that's the VAR. So this X is your value at risk. Now, binomial distribution, you might have got some sense by now that your VAR model can be accurate or faulty. So there are two possible outcomes. It can be accurate or faulty. So it follows a binomial distribution. As far as backtesting is concerned, it's follow the binomial distribution. So people who have forgotten a binomial distribution, you can just think of your FRM exam, wherein total number of questions are 100. Probability of getting correct answer is 25. That means 1 minus V. Probability of getting incorrect answer is 75%. And over here is 25%. Now, given that it can be either correct or incorrect, and if I ask you that what is the probability that you get 60 questions correct, I will put description box link. This question will be separately covered, but just to remind, so probability of getting 60 correct question would be equal to in how many ways 60 questions can be select out of 100 question times probability of getting correct question over how many correct questions you want 60, and 60 correct means 40 incorrect, and probability of incorrect question is 75%. So you need to verify that powers are tying back to 100, and for a correct question 25% probability, for incorrect question 75% probability, and there are 60 correct questions that we are interested in. So this quantity will get you probability of getting 60 correct questions. If you calculate this would be a very negligible number. So the interpretation is you need to study. Okay, this is for level 1. So you need to study hard. On the probabilistic basis, you cannot clear exam unless you are extremely lucky. So work hard for your exams. Coming back, the point I was trying to make is it's a binomial distribution that we will use. So this formula we will use. So now how aspects. So what we covered what is backtesting, why backtesting is done, prerequisites for understanding uh, backtesting VaR. Now let's see how do we calculate, how do we backtest our value at risk model. So let's understand with example. So hypothetically, suppose you have model predicting, say there is a model 99% VaR is $1 million for 1 year. So say there are 250 trading days in 1 year, and your model says that your 99% VaR is $1 million. It means only 1% of the time, that is approximately 2.5 days, that is approximately 3 days. 2.5 days is the exact number. 3 days is a approximately number where your loss will exceed $1 million. That's the meaning of value at risk. So only 1% of the time, that is on 3 days, you can expect loss greater than $1 million. So to understand backtesting VaR, what is done actually on daily basis, you are monitoring that what is your dollar loss. If your VaR limit is getting breached, so we should ask if the exception. So on 250 days, so you will have 250 observations wherein you will notice that what is your dollar loss. Say your dollar loss is on given first day it's 0.75, 0.25. On third day, say it was just 1 million, 1.5. So you will have this data set for entire 250 days. Okay, so for that, those 250 days, you will plot a distribution. Okay, you will plot a distribution. What is the average of this distribution? And so number of times. So actually the probability of getting 4 exceptions. That means how many times these exceptions were breached. So given there are 50 trading days, the expected number, that is 50% of the time, it would be, say, it's 1% VAR. So you are expecting 3 days. So expectation is that your mean of this distribution would be 2.5 or 3. So that is the reason 2.5. So you have the 95% confidence for this one. So that 4 exceptions that you saw in a Bessel table, those were just, I mean, those were not, Bessel did not got a dream that it should be 4. It has some background. So on this distribution has a 95% confidence. So if you multiply 2.5 with 1.65, you will get approximately 4. That is the reason you had a 4 in a green region. These can, no book will explain that these things, but yeah, this is actual background if you are interested. But yeah, I mean, we will calculate what is the probability of getting each exception in this case, and accordingly we will calculate the probability of type 2 error. But yeah, for this slide, just understand that 4 exceptions that were coming, you just monitor to backtest your VAR. On 250 days, you will monitor all your exceptions and you will plot a distribution. If your exceptions are below 4%, 4 exceptions, then you say your model is accurate. Or, I mean, you cannot say your model is accurate, but you need to have some statistical evidence to substantiate that argument. Say if there are 8 exceptions, okay, so still you cannot say your model is inaccurate. You need to have the statistical proof for that. It can be merely because of a bad luck. So we need to have some more data. It not just 8x, we got 8 exception, we can say that we are, our model is inaccurate. Just hypothetically, of course, we are given that green and, but yeah, you need to have the statistical proof. So that is a backtesting VaR. You plot this distribution at 95% confident and check if you have 4 exceptions, if you are getting 4 exception at a 95% confident. So that's how you backtest your VaR. So coming back to our questions, now given you have got some background of backtesting, so let's calculate. So in given question, it was 3%, but in your literature, both calculations are given. So if I were to calculate probability, like how we calculated probability of getting 60 correct questions, now what we are asked to calculate is probability of getting 0 exceptions. So what is the probability of getting 0 exception? What is probability of getting 1 exception to your value at risk model? What is probability of getting 2 exception? Likewise 3, all the way till 4. I would strongly suggest that you please do calculate these expressions to get more insight of this. Likewise, only difference would be over here your P is 0.01 and 1 minus P is 0.99. Over here, your P is 3%, probability of getting faulty model, and probability of getting accurate model is 0.97. So likewise, we need to understand what is the probability of getting 0 faulty models. So what I would do, out of 250 trading days, 0 exceptions, just applying the same formula into 0 exceptions, and probability of 0 exception is 0.01 into, so 100 accurate, sorry, 250 accurate days. So no, yeah, it would be 100% because over here it's 0%. So it's, I think we are doing something wrong. Give me a moment. In the exponent, it's probability. So over here, it would be it's like over here it's 0.01%, and how many? 0 exceptions times your 99% and all the accurate ones. So all accurate. So likewise, you can write 250. In how many ways one accurate model can be chosen? Sorry, one exception may come across out of 250. So the probability of that 1%, the power 1, and 249 accurate models. Likewise, we can have 250C2, 0.012, and over here it would be 99% and 248 accuracy model. So 248 plus 2, you can just verify it is 250. So 250 C3 into 1% and 3 faulty models and 247 accurate models. And over here 254 faulty models. Probability of those is 1% and 0.99 power 246. If you calculate, I have already done it on a paper just in interest of time, but I would suggest that just pause this video there and calculate these probabilities. It will help, it will make your binomial distribution understanding very strong. So these are approximate number. It is 8.1% and it is 20.46%. Likewise, this two exception, it's 25.74%. And this 3-1 is 21.49%. And this is 13.4%. Okay, likewise, you can just write probabilities of this one. What is the probability of getting 0 exception when your probability is 3%? So just the same thing, but the only thing changes is your 3% probability of getting faulty models. So same, I'm just applying same logic. 250C0, 250C1, 250C2, 250C3, 250C4 into bit of mechanical work here. So 3% over here, 0 faulty models. 0.03% over here, 4 faulty models. Likewise, we have instead of 99%, now we have 97%. So over here, it would be entirely 250.97, only 249 because one we have faulty. Over here 248. Over here we have 247. Or 97%, my bad, 7%, and it's 246. So I will just fill these tables quickly in interest of time. So this is 20.46%, 25.74%, 21.49%, 13.4%. Likewise, on this side, which is the case actually we are interested in for our question. This is just to validate your book. You have been given some information for this one, and this is the actual question that we are actually trying to solve. So over here it's 4.9%, 4.93%, and over here it's 3.81%, and it's like 1.47%, For 2, and for 3, we have 3.75%. And we have 7.16%. So if you notice, what we were actually asked to calculate is what is the probability of type 2 error. So if you recollect, type 2 error was that on this side, what you have on the right side, starting from all the 0 till 3 exceptions. So we were asked to calculate till 3 exceptions. So addition of this would give you 3. So it would be like say 4.93, and just give me a moment. I think there is problem with this. So please do calculate it. I have done it in Excel. I'll just share it right away. So for these 2 data points, it's 0.049%. It was not really 49%. It was 0.049%. Very less probability of getting 0 error. And over here it's 0.38% approximately. So if we add these up all, you will get around 5.7%, which is B. Likewise, in your book, what you have been given is, say for example, if you are supposed to calculate type 1 error, if your number of exceptions are 4. So you will calculate around, if you add these up all numbers till 4 exception, so these all cumulative probability of getting 4 exceptions. So this is probability of getting exactly 4 exceptions, but cumulative probability of getting 4 exception would be say around 89.2%. So this is a probability of getting, this was something that was in the, if you recollect, it is similar to 90% confidence you getting clear in exam. But what is a type 1 error? 1 minus this. So in this case also, if you subtract this, 99.1 type 1 error probability of type 1 error would be around 10.8%. These two numbers are shown in your book, 89.2, 10.8, and there would be something from this side also. Let me just present Excel that has a more insight of what you see. So this is what you actually were looking at table, but I wanted you to calculate it manually. In Excel, it can be done very easily. So if you just try to plot, this is what you will notice in your book. Exactly 4 number of exception. There would be some probability, say 49%. Sorry, 89%. Let me just add this up here. So this is your probability of actually getting 4 exception. But what is a type 1 error? That I won't get more, I would get more than 4%. So it's like 10.78% that you will notice in your book. Likewise, in this case, if there are 4 exceptions, I would get 12.82. Let me just sum this up. So this is what your question was saying, that this is the current probability, but what is the probability if Bessel changes the number of exception to 3? So this is something that was asked, 5.65% that was asked in your question. If you plot this also, something similar may occur. If the numbers of exceptions are dropped, this is what you will see in your this thing. Okay, so this was an Excel thing. That was a very easy thing. So in Excel, it's quite easy, but yeah, I would strongly emphasize that you calculate and check if the numbers are as expected. So this is what you calculated, and this is what there in your book also. You may cross verify this. This is for P equal to 1%. This is for P equal to 3%. And this is something that I have just, so if you enjoyed this video till here, like you got some insight of the concept. So there are a lot of students that are coming up with this problem that they have paid high fees and currently they don't are not getting that much values from the faculties. So we have come up with some plan. The link will be posted in the comment box, so you can just have a look. So the, I mean, if you're not able to apply concept, then it's a big problem. You may struggle a lot to solve question banks like this. This was a very easy question, but still there were a lot of queries on this. But yeah, I mean, of course, at the same time, there are four concepts that are getting applied. So bit challenging also, but at the same time, if you know your level one concept well, it's easy also. So we solved this. This was 5.7%. And second one is, suppose that your daily VaR level exceeded 22 days. So there is one formula. So like what we used to calculate is critical value. In this also, you can calculate the critical value. I mean, its confidence level is 95%. So your critical Z value is 1.65. But if you were to calculate Z value using this given information, what you will do, you will apply this formula. So you calculate Z value, compare with this. If you reject over here, you can say that model is actually faulty because this information is actually falling into the error zone. But if something comes up this in this area, you can say that model is unbiased or model is accurate. So let's quickly calculate this Z value. So Z is 22 days is actually something that is the VaR actually exceeded out of 250 days, and there are 250 days, and the probability of exceeding VaR is 5%, and under root 0.05 times 0.95 into 250 days. So if I calculate this, 22 minus 252 into 0.05, that is 12.6, and under root is 0.5 times 0.95 into 252. So under root 11.97. So 22 minus 12.6, it's 9.4, and square root of 11.97 is 3.46 approximately. I would just do 1 over x of this into 9.4. It's approximately 2.7169. So this would fall over here. So we can conclude that model is actually inaccurate because it's coming from this area. So you just say that model is inaccurate. Hope you like the video. If yes, please do subscribe to our channel. If there are any doubts on this video, please comment it and like the video as well.